Well, markets are lower as investors assess the possible threat of war. Russia's attack on Ukraine could have direct effect on consumers in North America. Our next guest believes the latest developments could give the Fed an excuse to let inflation run hotter as it tries to ensure the public that the Russia situation will not have long-lasting economic consequences. Joining us now is Michelle Schneider, Managing Director at Market Gauge Group. Michelle, thank you a great deal for joining us. Your take on the market panic that we're seeing in many markets today.
Well, certainly it's not surprising considering that the market has been very orderly going down for the last several weeks. And also we saw signs of the market going to turn over back in November, really where it started with the small caps. They started going down in November long before SPY and the Qs. And of course, then the Fed came in and chimed in about the high rate of inflation and their intention to stop the bond buying and start raising rates. So this Russia-Ukraine situation was really the catalyst to bring in a lot more selling. The situation, though, is at this point, even though people are talking about bear market territory, which if you use the definition of a 20% decline as a bear market, yes, but we look at things a little differently. Even though we've broken down from a year of support, let's say, particularly if we're using a 50-week moving average, we still have a lot of support coming into the market at around the 200-week moving average, which tells me that if IWM in particular was the first to fall, it's going to be the first one to let us know that maybe the hysteria that we saw today is actually ultimately going to be a buy opportunity. We don't know that yet. But what I will say is the market opened up, and IWM in particular took out the January low for like a nanosecond, then flipped up, and now it's about $3 higher from there. So we're still getting this dip buying, which could be a good thing, but also could be a dangerous thing. I'd say it's too soon to tell, but I'm really looking at the market eventually being more range-bound, a la what we saw back in the late 60s through the 70s, 1982, which is a stagflation where the market basically just goes within a broad range.
What about commodities? Commodity prices are soaring in most parts of the commodity world today. Oil, perhaps most notably, gold as well. Will these shifts higher in commodity prices be durable?
Well, again, I have to say that oil, relative to inflation, and gold both were still undervalued. Actually, I know people don't like to hear that because it really pinches our pocket, particularly with gas prices going up so much. But it's not totally unexpected. We came into 2020 with a ratio at a 100-year low between equities and commodities. So that gives you some idea. If you just take away all the fundamental noise and you just look at that, you knew that wasn't sustainable. So then you have all of the evidence that happens, starting with just some normal drought conditions, low production, COVID, stimulus, easy monetary supply. All of this contributed, and we're still really, in terms of gold, if you look at it versus where things were in 1980 in the Dow, we're still undervalued. So I do believe that regardless, because the Fed's hands are tied now to really go crazy, to be hawkish, like Volcker did in 1982, we're going to see more higher prices and more pain in not only the gold and the precious metals, but in the oil market. And then, of course, in the food market, in the grains, which we've talked about for a while. And then you've got Mother Nature on top of that. So, yeah, I would say this super cycle of commodities is definitely here for now.
Okay, let's bring up a screen of your investing ideas. And quite likely these ideas were sent to us before the world knew that Russia was attacking Ukraine. But let's bring them up nonetheless. Medical devices, you like solar stocks, you like soft commodities and precious metals. We've touched on that already. And you like one stock, Solana. It's a blockchain platform. Why don't we start with medical devices?
Well, I have my theory on medical devices is that a lot of the just typical procedures that people forewent if that's the right word, during the whole COVID will start to come back. People will start to go back to the doctors for their normal procedures, and that could benefit some of these medical supply type companies like Intuitive Surgical, Baxter, there's a whole bunch, Medtronic. And so IHI, which is the ETF, interestingly enough today, held the lows that we were looking at, and at this point now are trying to stabilize. So as soon as we see some level of stabilization in the market, that would be a place to go, because I think we can see some good upside there. As far as the solar energy, I think one of the silver linings of this whole, I'm sorry, you didn't ask me about it, but I just assumed.
Go ahead. Go ahead.
All right. Sorry, I'm on a roll. The solar energy stocks could benefit because as prices of oil continue to go higher, if you look at where solar energy is, it's still, again, relatively so undervalued. If you look at something like TAN, which is the ETF, it just also held at around $55 per share, which I think is another really good place to look at to see if that's going to develop a floor, because we're going to have to go to alt energy. I mean, just logically, it makes sense. We're going to have to go more to EVs. Survey said barrel, if gas goes to $5 a gallon, people will start thinking about their next cars being EVs. So that's why I'm watching that carefully as well.
Okay, let's go to the one stock specific idea you've got. That's Solana.
Well, Solana is actually a coin, and so essentially I'm looking at, I mean, there's this whole debate about gold versus crypto, and I don't really like to get involved in that debate. I think Solana right now is going to be mainly impacted by what happens with Bitcoin and Ethereum. But the happy news is that even with this sell-off, that we have seen both Bitcoin and Ethereum hold the 2022 lows so far, where we broke it in equities, which tells me that if those stabilize, Solana, Ethereum, and even Bitcoin could wind up being a very low-risk buy opportunity. But again, patience probably makes the most sense at this point.
In the past, you've liked travel and leisure stocks. Does the shock that many people are feeling around the world at the events in Ukraine change your view there?
No, not really. In fact, if you look at some of the restaurant stocks today, particularly one that we've been watching, which is Cheesecake, it's actually green. So regardless of what goes on geopolitically, even though people scale back, obviously, because of inflation, which is a completely separate thing that can be exacerbated by Russia, people still are going to go out to eat. They're still going to travel. And once this COVID is really in the rearview mirror, which seems like that is definitely the trend, I think we'll see that come back robustly if we go into recession, maybe not so much, but considering where we were, which was basically at almost nothing in terms of what people were doing, we will definitely see some improvement there as well.